Picture the year 2000. You are standing in Sunnyvale, California, in an office that feels less like a corporation and more like a carnival that somehow went public. The walls are purple, the hallways hum. The stock is worth, on paper, something that strains comprehension, $125 billion in market capitalization at its zenith, a figure that made Yahoo not merely a company, but a statement about what the internet could become. Analysts called it the front page of the web. Employees called it the future. Investors called it inevitable. Then look again, not at 2000, at 2016. The offices are quieter now in ways that have nothing to do with time of day. The product roadmap is a ruin of abandoned pivots. The stock tells a different story entirely. And in July of that year, Verizon, a telephone company, a company that strings copper wire between poles, agreed to buy Yahoo's core internet business for $4.8 billion. The same asset that, at its peak, had been worth more than 25 times that sum. No alarm went off. No single morning arrived when everyone knew it was over. That is the most important thing to understand about what happened to Yahoo. It did not collapse, it drained. Jerry Yang and David Filo were Stanford graduate students in 1994 when they built something they called Jerry and David's Guide to the World Wide Web. It was, at its core, a hand-curated list of websites, a librarian's solution to a library that was growing faster than any librarian could keep up with. They renamed it Yahoo, an acronym that stood for yet another hierarchical officious oracle, though what it really stood for was this: someone has already sorted the internet for you. The world rewarded them extravagantly for that act of curation. By 1996, Yahoo had gone public. By 1998, it was the most visited site on the web. By the turn of the millennium, it was offering email, news, sports, finance, maps, chat, shopping, and entertainment, a bundled life online, at a moment when most people were experiencing the internet for the first time and needed exactly that kind of hand-holding. The culture reflected the moment. There was genuine talent in those buildings, engineers, editors, product thinkers who believed they were building infrastructure for the next century of human communication. The stock options made people wealthy on paper. The press wrote in superlatives. And there was, coursing through the whole enterprise, a particular kind of confidence that only comes when a company has been right about something very large, very early. Yahoo had bet on the internet before most institutions took it seriously, and the internet had arrived. What could possibly go wrong? That confidence, it turned out, would become the primary instrument of the company's undoing. In February 2008, Microsoft made Yahoo an offer, $44.6 billion, to acquire the company outright. It was a 49% premium over Yahoo's trading price at the time. Steve Ballmer wanted Yahoo's search traffic, its advertising infrastructure, and its audience, a combined entity that could, in theory, challenge Google's growing dominance in online advertising. Inside Yahoo's boardroom, the offer was received with something that mixed genuine deliberation with an emotion harder to name precisely, something adjacent to offense. Jerry Yang, who had returned to the CEO role the previous year, reportedly believed the offer undervalued the company. Some board members agreed. The argument made at the time was not irrational on its face. Yahoo had hundreds of millions of users, a global brand, and the reasonable expectation that its display advertising business would continue growing. Microsoft's offer, the thinking went, was opportunistic, a bid to acquire at a discount what Yahoo could build independently into something worth far more. There were people in those rooms who disagreed. Reports from the period suggest certain board members and advisors believed the Microsoft bid represented a genuine lifeline, that the competitive pressure from Google was more structural than cyclical, and that Yahoo's trajectory without a major partner was uncertain at best. Those voices did not carry the day. The assumption baked into the rejection, and this is the crucial point, was that Yahoo's value was a floor, not a ceiling, that the company was in a temporary valley, not a permanent decline, that independence would allow them to compete, to innovate, to hire, to acquire their way back into dominance. It was a bet on Yahoo's own potential. It was the kind of bet that successful companies make all the time, based on track records that had, until recently, been genuinely impressive. What made it catastrophically wrong was not that the bet was irrational. It was that the people making it were using the wrong map. They were reading a market that had already shifted under their feet while still navigating by landmarks that no longer existed. In the months after Microsoft withdrew its offer in May 2008, Yahoo entered a period that would be characterized, in retrospect, by an almost systematic inability to choose a direction and hold it. Google had already won the search advertising market, not narrowly, but decisively. By 2008, Google controlled roughly 60% of US search queries. Yahoo's search share was shrinking, and search was where the money was. Every additional point of search share that migrated to Google meant not just less traffic, but a compounding advertising revenue deficit. Because search advertising converted at rates that display advertising, Yahoo's relative stronghold could not match. The company's response was a series of strategic pivots that followed one another too quickly to complete. In 2008, Yahoo outsourced its search technology to Microsoft under an agreement called the Search Alliance, a decision that generated short-term cost savings but effectively acknowledged that Yahoo could not compete in the core technology underpinning its own business. Search had been Yahoo's product. Now it was a licensed service. The brand remained. The engine was gone. Between 2008 and 2016, Yahoo cycled through 5 chief executives. Each arrived with a thesis about what Yahoo needed to become. Each departed in varying degrees of acrimony without completing the transformation. Carol Bartz, who took the CEO role in 2009, was terminated by phone in 2011 after a tenure marked by operational restructuring that never resolved the strategic question at the center of the company's existence. Was Yahoo a technology company or a media company? The answer mattered enormously because it determined where to invest, whom to hire, what to build, and how to price the advertising inventory that funded everything. Marissa Mayer arrived in 2012 from Google, and her appointment briefly reignited a kind of institutional hope. She was a genuine technologist, a product thinker, and her early moves, redesigning the mobile apps, acquiring Tumblr for $1 billion, improving Flickr, had the quality of conviction. But the thesis underlying her tenure proved difficult to execute at scale. Tumblr never monetized effectively. The core advertising business continued to lose ground to Google and, increasingly, to Facebook, which was capturing the social advertising market with a precision targeting capability that Yahoo's aging infrastructure could not match. By 2014, Yahoo's revenue was declining in the segments that mattered. By 2015, the board was openly discussing strategic alternatives, a phrase that, in corporate language, is often a prelude to sale. A proposed spin-off of Yahoo's stake in Alibaba, a genuinely valuable asset, became entangled in tax complications that consumed significant management attention and board bandwidth. During a period when the operating business needed focus, it was not receiving. Layoffs came in waves. In 2008, in 2012, in 2016. Each round was accompanied by language about efficiency and focus. Each round was followed by another reorganization that raised the same structural questions the previous reorganization had failed to answer. The people who left took institutional knowledge with them. The people who stayed increasingly operated in an environment of uncertainty that made long-term planning feel futile. The press, which had once published portraits of Yahoo's founders as visionaries, began running postmortems while the company was still operating. Technology journalists documented each strategic reversal with a precision that, read in sequence, resembles a case study in how institutional momentum can sustain a company long after its strategic coherence has dissolved. By early 2016, the sale of Yahoo's core internet business had become less a question of whether than of when and to whom. The board formed a committee. Investment banks were retained. Potential acquirers were contacted. The last day of Yahoo as an independent operating internet company arrived not with a dramatic announcement, but with a regulatory filing and a press release. In July 2016, Verizon Communications agreed to acquire Yahoo's operating business, its mail, news, sports, finance, and advertising technology assets, for approximately $4.8 billion. The deal closed in June 2017. The employees who had joined Yahoo in its heyday to build something they believed would last, who had negotiated salaries and relocated families and declined competing offers because they believed in the company's trajectory, learned about the sale the way most people learned about most major corporate events, from the news. Some had already left. Many had been laid off in the preceding years. Those who remained went through the process of transition that any acquisition produces. New badges, new reporting structures, new corporate values printed on new wall art in the same buildings. The financial loss was measurable and stark. The human cost, the careers interrupted, the professional identities built around a brand that was being absorbed and gradually retired, the particular grief that comes from watching something you helped build become something else entirely, did not appear in the transaction documents. Verizon eventually merged Yahoo with AOL under a brand called Oath, later renamed Verizon Media, and later sold to a private equity firm called Apollo Global Management in 2021 under the name Yahoo once again. The brand survived. The company, in any meaningful sense of what it had been, did not. The lesson that Yahoo's story teaches is not about innovation. The word gets deployed too easily in these retrospectives, as though the failure to innovate were a character flaw rather than a structural condition. Yahoo's engineers were capable of innovation. The company produced real products used by hundreds of millions of people. The deeper lesson is about what happens when a company builds its identity around being the center of something that is in the process of becoming decentralized. Yahoo succeeded by being the place you went when you went online. The internet, as it matured, stopped having a center. Search made it navigable without a guide. Social networks made it personal without a portal. Mobile made it ambient rather than destination-based. Yahoo's entire architecture, its business model, its product philosophy, its advertising proposition, was built for a version of the internet that was passing away even as Yahoo was perfecting it. The trap Yahoo fell into is not unique to Yahoo. It is the trap of category dominance, the belief, earned through genuine success, that the category you lead is the category that will matter. It is the way that being very good at something can make it genuinely difficult to perceive when that something is becoming less important. The decision to reject Microsoft's offer in 2008 was not made by fools. It was made by people whose entire professional experience had taught them that Yahoo's value was real and growing. They were right about the past. They were wrong about the future. And the instruments they were using to measure their situation were calibrated for a world that had already begun to change. Every organization has a version of this, a business line that has always worked, a customer relationship that has always renewed, a market assumption so foundational it has stopped feeling like an assumption and started feeling like gravity. Yahoo's story is a reminder that gravity is not always what it appears to be. Yahoo still exists, technically. The brand name has persisted through multiple acquisitions, renaming exercises, and ownership changes. Hundreds of millions of people still use Yahoo Mail, Yahoo Finance, Yahoo Sports products that continue to function, continue to attract users, continue to generate advertising revenue under management that has nothing to do with the company that Jerry Yang and David Filo built in a Stanford trailer in 1994. The infrastructure outlasted the vision. The name outlasted the identity. What ended was not a website, it was a particular belief about what the internet was and what it needed. Perhaps the most honest way to understand Yahoo's rise and fall is this: they were not wrong about the internet. They were wrong about how long they had.